But there's a few things that I think are very relevant to the discussion today on the macro side, and one of them is has been actually developing quite recently, as you can see in this chart. This is not a long-term chart. It's actually it's got about 2 years of horizon or so, a little less. But you can see a relationship between two things that I've been following very closely. I've been noticing the signs of stagflation are becoming more and more evident, and this is a good way to measure that. Um, you're looking at the 10-year yield, the normal 10-year yield, nominal, on blue, and the white line, you're looking at the break-even rate, which is the 10-year yield as well, which is essentially the inflation expectation by the market or the CPI expectation by investors. And what you're seeing here is a divergence. Inflation has been moving higher, with commodities actually continuing to also have a resurgence of growth in prices. At the same time, economic activity is going the other way. There's many ways you can measure this. There was a last week, I think, was one of the most important weeks for macro data. There was the super core index by the Fed, which the Fed has mentioned a few times already, not a few, many times in their press conference as one of the things they've been looking at, of which I disagree completely. Is an index that basically, it's one of those that basically excludes everything that matters, and the other stuff stays the same. And but even that, they're actually, if you look at the normal, the annualized number of that data last week was up about 9.5%, which is insane. 9.5% on the inflation data is, I mean, I think it speaks for itself. On the other side, another data point that came out last week that I think was very relevant is the retail data. Retail numbers, they come out on a nominal terms. In other words, they include inflation. And that number came out, again, I'm going to annualize a monthly data point, was a decline of over 10.5%. So if you add inflation, I mean, this was a very significant contraction in real terms. Well, I find this, another clear evidence of inflation in the system as economic activity is actually falling. So stagflation, textbooks, stagflation, in my view. Let's go to the next chart. Next chart is showing something that I haven't seen people talk about, but I was curious because I've been looking at data on inflation had been rising, and it brought me to the idea. Well, let me plug this into the Taylor rule model. And Bloomberg actually has a whole formula where you can plug in different indices for your inflation data point that you want to use. So I use the CPI number just for the sake of this measurement. But you can look at the PCE, the core PCE, core CPI. Look, or now even better if you look at commodity prices. But that was in a drop down options. But here you can see that the Taylor rule is essentially giving us a suggestions of where interest rates should be according to this formula, and it's what I think. Yeah, it's 6.5%. It's a lot higher than 4.5%. But I think what even more important here is the fact that we're seeing a divergence. The Fed is cutting rates as the Taylor rule is telling you to actually raise rates quite substantially. Actually, it's a 200 basis point spread between the two. So, you know, what where do we know what's another observation that I think it's important here? When the Fed was raising rates back in 2021 with inflation rise and so forth, uh, Kevin was showing a chart of interest payments relative to GDP. Boy, we were at 2% at that time, about around 2%. Today, we're approaching 5%. And I know that chart was showing a 3% figure for today, but you got to do the federal and the local, right? That's the real world. The other world is just looking at the federal. The real world, you're paying both. You're paying the local and also the federal. And so in the real world, you're paying 5% of GDP. How do you raise rates today? Now, how do you take rates back to the suggestion here in this chart of 6.5%? And I just see that as completely out of the picture. And if that's the case, there's a lot of things we can extrapolate in a world where the Fed simply cannot handle or cannot raise rates or fight inflation in an environment that is also clearly happening, where inflation is resurging on many fronts. And so, this is a place where I think we've been thinking about that we're going to get into, which is suppression of rates, despite the fact that inflation could be running hotter than expected. And to me, this is again, classic stagflationary environment, but also really, really positive for hard assets. Let's go to the next chart. In the next chart, it's something I've been noticing as well, which is junk spreads. If you follow markets in the macro world for a long time, I think one of the measurements that I like to point out as something that tends to talk about a index of complacency. That's the junk market, or the junk spreads market. Basically, you're looking at how much a company with the lowest rating on the credit front can borrow money relative to how much the government can borrow money for. Remember, the government, although it has risks and all sorts of issues, it can print money, it can do whatever it wants, and so the risk for default has to be significantly smaller than a junk company, or junk rating company, or rated company. And therefore, at moments in history when you see the spread between these two to fall apart, like today it's at around 2.5%, usually are times when markets overall are putting too much complacency when it comes to risk. And so, I thought this was interesting. I was curious to see, I looked at it and I was like, wow, we've been below this 3% number for some time now. And I was curious, now how many days have we seen this? It was exactly 100 days. So I was like, whoa, this is interesting. Well, let's look back in history and see how many times in history have we seen this. Well, just one time, and this was in May of 2007. For those who remember that period, was a time when, right after that, we did see 2 months after that, we did see a volatility event. Now, I think that's reasonable. I think that's potentially a guide, or a model for us to follow. That volatility is likely to pick up substantially in the next 2 months or so. I think that would be, very plausible. I think that complacency to this degree is unsustainable, especially when you have two things going on. You're seeing fiscal cuts, right? I mean, all fronts. Kevin was mentioning defense spending and also, I mean, clearly there's an effort towards cutting fiscal spending. I mean, fiscal spending has been the engine of growth of the U.S. economy, by the way. I mean, in my view, if there's one thing I have to point out about why we've seen the growth we've seen so far since the global financial crisis, I mean, you have to point out to the average of 8% of fiscal spending relative to GDP that we ran since 2009. And so if we're now talking about reducing that amount, that has to have an impact on growth. The second thing that's happening too is, if you look at central banks globally and you look at their amounts of assets that they own on their balance sheet, that has been shrinking as well. So those are two things that are factors that tend to reduce liquidity in the markets at the same time as you have timber ready to burn, which is junk spreads. Let's go to the next chart. This is a research that I saw on Twitter that I thought was interesting, and maybe I could do it slightly differently, but they're looking at the PE ratio by Shiller, Robert Shiller, and every time we reach the above 38 level, which is very expensive. I mean, historically, we don't see markets hitting that level. In fact, throughout history, and this chart is showing 2 times. Actually, we should have. No, I think the chart should have gone back to 1929 levels, and I believe that would show similar expensive numbers as well. But basically what's shown here, every time we go above the 38, show me what happens. And you kind of have this period, which I guess it's similar to what Druckenmiller was talking about. When you get to the 7th inning of the market of any asset class, you can make a lot of money on the 7th to the 9th inning. And I think that we hit the 7th inning a while back. It's not like we're hitting it now. And you can see that 7th inning in during the tech bubble was substantial growth. I mean, we saw 80% increase of the of this metric I think it's an appreciation of the PE ratio specifically. Well, actually, performance. It's a performance of the index. So you had a performance of the index about 80% after you hit that, call it seventh inning. But we've been there already, like I said before. We've been hitting close to the 5 months, mark after the 38 level has been hit. And so this is playing out kind of like the July 2021 levels or so forth, where markets did contract quite a bit. And so I think that's actually something we should be aware of in terms of risk. And valuations do matter at some point. And I think there's perhaps too much complacency out there. Let's go to the next chart. One thing that it's a sign of maybe some rational or rationalization coming back to normal, or just common sense, as I like to say. I think the world needs a shot of common sense in this environment. I mean, I would never ever have thought that a currency called fart coin would reach a level of $2.5 billion worth of a market cap. I mean, that just seems something that was way out of my at least my estimates of what the economy would have done. And it's now down about 88%. So all fart, we're down 80, almost 90% on this. That makes sense. I also like to say that back in the tech bubble, at least, companies are being bid up at that time to very expensive multiples. But at least they're companies. At least they're working towards a business model. And this time, we're just seeing meme coins. Like, I don't even know what this means. Like fart coin. Like what is what is a capital used for? It's a total waste of capital. Just it's ridiculous, really. So the fact that we're coming down on these things, it's important. It's I think it's a people are not really paying attention to these things. Palantir and some other stocks are definitely coming down. Those are like the leading, most favorite stocks from retail investors in particular. And so I think things are coming back to more of a common sense. Those are early signs of it, are very early signs, and there's a lot more to go. But I would pay attention to these things because they can have implications in the broad market as well, as we see other technology companies hitting a wall here as well. Let's go to the next chart. All right. Well, inflation is in fact moving higher. One thing that caught my attention was natural gas prices. I mean, it's been trading like, not that there isn't wars happening, but it's trading like there's a new war breaking out or something along those lines. I mean, this is literally how nat gas was trading back in June or so or May of 2022 when Russia invaded Ukraine. And I do think this has to do with some of that. I mean, of course, there's issues between Zelensky and Trump recently, and I'm sure that has been having an impact on natural gas prices. But there's also more to this. I mean, there's also the issue of electricity consumption, supposedly growing substantially because of AI, because of onshoring. Clearly there's demand for energy today, and natural gas is taking advantage of that. I find it interesting the fact that oil has not been participating on this. If you ask me, I think that oil will also participate in this on this whole upward trend of commodities and other inflationary signs. But clearly this is a very inflationary data point that we need to point out. It's about growth of 70 or 65% since November. You annualize that number, and you're going to get a big number of growth on your bills. So this is going to hurt consumption for sure. Let's go to the next chart. One thing that's been thrown out there as that we should at least consider as an idea, that Trump has been talking about, and Musk has been talking about, has been this dividend from the Doge. Efforts that we're seeing. So you're talking about $5,000 of checks that will be sent to the bottom 50% of the population. So 75 million of taxpayers would be receiving a $5,000 check in the mail. And this to me is just we're just taking away wasteful capital that was being spent and given in the hands of the population. to spend. And I think that the ultimate, despite the fact that it's not new money coming in, it is capital that will be spent differently. And I would suspect that the bottom 50%, the way they tend to spend money, should have an impact on inflation. No, I happen to live a life where my parents had a store of selling kids clothing back in the 90s or so. And it was kind of it wasn't a high end store with brands, but it was kind of like middle ground of not low end either, of kids clothing brands. And what we used to talk about back in those days was that our best clients at the time were actually the bottom 50%, the less privileged people in terms of capital. And the main reason for that is because their spending habits are different. There's a lot of times there's a reason why people stay on the bottom 50% is because of their spending habits. And this is not I'm not trying to poke fun or anything about people that are in the bottom 50%. I'm just making a comment about general spending behavior that we tend to see. And so I do think this is inflationary at the end of the day, and we should be paying attention to this as well. Let's go to the next chart. So now we're looking at what I also would maybe suggest as one of the most important things going on is the dollar. The dollar, again, the media and a lot of people have been painting the dollar with this strength that we're seeing. And it's not really the case. In fact, the dollar is falling quite substantially. If you look at a weekly chart, we're breaking some pretty significant levels recently here. It's a little bit of an older chart, but still, the dollar is literally actually lower than the level that I'm showing in this chart, of which has been kind of, remember, a lot of people are off, in terms of positions for a devaluation of the dollar. A lot of people are very long the U.S. dollar versus other currencies, especially the Canadian dollar. But remember, another thing that has been happening more recently has been the rise of the Japanese yen. The Japanese yen back in August of 2024 was one of the main reasons why we saw the market having a correction. So, this again, another rebalancing happening. The BOJ is in a better position to raise rates and fight inflation than the Fed, believe it or not. And that's just because it's a function of how much you're spending to service the debt. And in Japan, they're spending 0.9% of their GDP, while in America, we're spending close to 5%. So, that's things have to be adjusted, and the currency will be adjusted accordingly, in my view. So I think the dollar's at a turning point. I've been saying this for a while now. Process of writing a letter, which I will discuss more some of those views. And I think this is all very, very relevant for gold, very relevant for the miners, very relevant for emerging markets. There's a lot of things that tend to be triggered by a declining dollar trend. Let's go to the next chart. Here's a very interesting chart. Now I'll give the credits to Andreas Steno from Steno Research. That was at least the first person I saw showing this chart. It's basically looking at the trend of the DXY index in Trump's first term and this second term. And he showed this chart at the very beginning of Trump's presidency, and I thought it deserved to be updated. So I did that, and as you can see here, we kind of peaked at this kind of almost perfectly at the same time as the prior time, or the prior term. And I think we're going a lot lower. That's my view. Now I'll stick with that because of real macro constraints that will cause the dollar to fall versus other currencies. Let's go to the next chart. So now we're looking at an interesting development as well. Swiss gold exports to the U.S. surging. Wow, I mean that's a big number. We're now talking about auditing Fort Knox. I mean, there's a lot of things going on there that could be very market impactful events. I mean, what if? Now, I'm not going to throw conspiracy thoughts here, but people often say that the U.S. does not have the gold that they have reported. What if they have more that they have reported? I mean, all these things are on the table, or maybe they just have what they have reported in the past, and it's going to be a nothing burger. But I'm open-minded to those conspiracies because given the world we're living in today, it wouldn't surprise me if the Fed decided to, in a hidden form, or the government purchase some gold in this environment. I think that would make sense. or the other side of it, it wouldn't surprise me the stupidity of maybe selling some gold and not having gold in their balance sheet, of which would be, yeah, a huge problem for the U.S. dollar, in my opinion. So, I think that those things are all. I've said maybe this a while back, but I think a lot of people are having a true, history lesson about gold, as especially in the last few weeks. And I actually think they're going to have a history lesson about silver in the next few months as well. Let's go to the next chart. Emerging markets, it's still, some emerging markets are starting to move. Pay attention to this. I think the Brazilian real and the Russian ruble are both having their best performances relative to all currencies. Now, the ruble is a little harder to get behind, obviously, but the Brazilian real, does make sense. It's been appreciating quite significantly in this year, and will obviously have an impact in their economy, in Brazilian economy. And if you look at the link between gold and emerging markets, I think we're getting to that stage where the derivatives of gold are looking even more attractive than gold itself. What are those derivatives? Well, that's silver. That's no. I think that's probably the biggest derivative of gold itself. Who would have thought silver would be trading at a gold to silver ratio of 90, while gold is while trading at around $33 an ounce or so. I mean, that's extremely bullish in my view. And then you have other things like the miners, of which, if we go to the next chart, you can see the big margin that we're seeing. Gold is approaching $3,000 an ounce. And if you look at the all-sustaining cost for most mining companies, this is a median calculation across all 50 miners by market cap. So top 50 miners by market cap across the Canadian and the U.S. stock exchange. You can see that we're actually, those guys are mining at around 1,500 gold prices, while gold is approaching 3,000. It's like a double. And you may say, well, there's some other things in between. All right, throw another 300, another 400. Even if gold prices fall $500 from here, which would be a very large decline, mining companies are still printing money in this environment. So, I think that the worst is behind us for mining companies. I think this is probably the best period we've seen for producing metals, if not in history. And it's really interesting what's going on. Markets are not catching on to this yet, but in my view, especially private companies that are not seeing their shares trading on a daily basis, they're taking advantage of this. They're looking good with their margins. That's for sure. Let's go to the next chart. And lastly, if you want to go out on a good note and a positive note, let's just look at this chart for a minute. I mean, wow, this is wonderful. It's silver adjusted for money supply, and it's a double bottom. Last time we hit those bottoms, it was back in early 2000s, and that was a time when silver took off relative to money supply. If you actually step back a little bit and look at silver prices adjusted for money supply all the way to the 70s, what you're going to find at today's levels is almost 90% lower than it was back in the peak of the silver prices adjusted for money supply. That maybe give you a roadmap of the potential of what silver has ahead, in my view. That to me is asymmetry at its best. And so to me, I continued. I think there are times that I've been following silver for a very long time, and I would say that there are times you want to be following even closer, and that to me is a time. It's not just following. It's expressing this in the markets. In our view, at least that's what we do. And so to me, this is a time, one of those times in history that you want to be watching this extremely closely, because I think silver looks ready for an explosive move again.